recently came across this article which found that around 3/4 of Brits don't invest. Now immediately I thought this is probably because people don't have the spare cash to invest, given that we are in a bit of a cost of living crisis. However, Barclays have claimed that around 13 million UK adults hold 430 billion in cash savings. This would suggest that there is certainly some value in many people's accounts which are just simply not being utilised. They found that the main reason for holding cash savings and not using it to invest was mainly due to a lack of knowledge and understanding of investing, with another interesting key point being that they felt low confidence in the ability to pick the right investments. So I thought I'd make a video to help with that problem. Whether you've never put a penny into the stock market or you're simply looking to get started, I'll guide you through each step of the way to take you from zero to fully investing. This will be really beginner friendly and we'll talk about what the stock market is, what to invest in and how you can get started. We've got a lot to cover, so let's dive straight in. So first up, what is the stock market and how does it work? Let's start with the basics. The stock market might sound complicated, but it's actually really simple. The stock market is a place where companies sell small shares of ownership in that company to the public. By buying a share, you own a small piece of that company. For example, if you bought one share in Apple, you become a partial owner of Apple. If the company grows and does well, the value of your share increases at the same rate. Some companies may even pay you a portion of the profits in what are called dividends. Now, why do companies sell shares in the first place? They do this to raise money for things like expanding their operations, launching new products, or paying off debt. The stock market itself are made up of exchanges. So in the UK, we've got the London Stock Exchange. In the US, you've got something called the New York Stock Exchange. These exchanges are essentially platforms for people to buy and sell their shares. Now, most trading is actually done online now, so you don't need to be a trader in a suit and a tie to get involved. But how do you know what to invest in? This is where most beginners get stuck. There's loads of companies out there, so how do you know which ones to buy and which ones to avoid? This is where index funds and ETFs come in. So what exactly are index funds and ETFs? First, we need to understand what an index is. An index is a group of companies used to measure the performance of a specific section of the market. For example, we have the FTSE 100 here in the UK, which tracks the 100 largest companies listed on the London Stock Exchange. In the US, you have what's called the S&P 500, which tracks 500 of the largest companies in the US. Now, these index are used as a bit of a barometer to see how that particular market is performing. Now, an index fund or ETF is there to replicate the performance of that particular index. So if we take the FTSE 100 as our example, if this grew by 5% over the period of a year, then in theory your investment within the index fund which tracked that index would also grow by 5%. So why would we use index funds and ETFs? Investing in an index fund or ETF takes a lot of the guesswork out of choosing individual stocks. Instead of trying to predict which company will do well, you're investing in the entire market or a specific sector. Now at this point you might be thinking, okay, that takes some of the guesswork out, but still, how do I know which market or sector to invest in? This is where a global index fund or global ETF comes in. If you want to keep investing super simple, a global index fund like the Vanguard FTSE All World ETF is a fantastic choice. Straight away, it offers diversification. This particular fund includes over 3,000 companies from both developed and emerging markets worldwide. It means your money is spread across industries and geographies, reducing your risk. I'm sure you'll recognise some of the companies listed here, such as Apple, Google, Meta, etc. These global funds have delivered an average annual return of between 8 to 10%, depending on the index. With a fund like this, you're getting a diversified portfolio all within one fund, so it makes things super simple. There's also no need to analyse the stocks or rebalance any stocks within it, because the fund does that for you. By choosing a fund like this, you're setting yourself up for long-term growth with minimal effort. It's a hands-off approach that actually works. Now, I've used this Vanguard ETF as an example, but there are some others that you may want to look for. You've also got the Invesco's FTSE All World ETF with the ticker symbol FWRG. You've got the Legal & General Global Equity ETF, which is LGGG. You've then got the SPDR MSCI World ETF with the ticker symbol SWLD. And then another great option is the iShares Core MSCI World ETF, SWDA. These funds all do a fairly similar job, so the results will be fairly similar, but I thought I'd provide you with a few options so you can go away and do your own research. So now you understand the stock market and know what to invest in, Let's talk about how to actually get started. Now, step 1, here in the UK, you'll want to open what's called a stocks and shares ISA. Now, you could also open a general investing account, but it would expose you to taxation. With a stocks and shares ISA, you have a £20,000 allowance, and it also means any gains that you make within the market are free from taxation. If you're in the US, the closest thing to that is a Roth IRA, so you may want to check that out. Step 2 is about choosing our platform. There are many platforms that will allow you to open one of these ISAs and start investing. A few popular ones are Vanguard, AJ Bell, Hargreaves Lansdown, Trading 212, Fidelity, Freetrade and InvestEngine. However, the one I'd recommend is InvestEngine. It's ideal for simplicity and cost efficiency. InvestEngine has a 0% platform fees for DIY investors and offers a massive range of ETFs. Whichever platform you decide on, make sure you look for the FCA approved logo. This ensures that the platform is regulated and your investments are protected under UK law. Now, any of these platforms will require some fairly basic information and can all be done within a few minutes if you have the documents to hand. Firstly, you'll need to be at least 18 years old. Secondly, you'll need a valid form of identification such as a passport or a driver's license. Third, you'll need proof of a residential address like a utility bill or a bank statement. This has to be dated within the last 3 months. And finally, a bank account is required for funding this stocks and shares ISA. Now that we've opened our account and chosen our investment, it's now time to set up monthly contributions to invest. This approach is known as dollar cost averaging. It involves investing a fixed amount of money at regular intervals regardless of market conditions. Over time, this strategy will help reduce the impact of market volatility and ensures you're building a consistent portfolio. All of the platforms that I mentioned will allow you to do an auto-invest option, where on whichever day of the month you choose, that money will be deposited into the account and invested within the funds that you choose. Again, this means investing can be as simple and hands-off as you like it to be. Now, with our plan laid out, let's see how this approach could stack up over the long term. For this example, I will use £250 per month as our investing benchmark. However, in reality, this could be as much or as little as you like, as long as you're within that £20,000 annual allowance. So if we invested the £250 a month with an average annual return of 10%, after 5 years, we'd have £19,500. After 10 years, we'd have £41,000. After 20 years, we'd have £157,000. After 30 years, we'd have £453,000, but quite staggeringly, after 40 years, we'd have just over £1.2 million. This is the power of consistent investing and compound interest. The earlier you start and the more consistent you are, the more your money grows over time. So there you have it, a quick beginner's guide to investing. I hope this guide has given you a starting foundation to investing. To quickly recap, the stock market is a tool for building wealth, and it's simpler than you may think. Index funds and ETFs take the guesswork out of investing and help you achieve consistent long-term growth. And the final point is that you can start today with a stocks and shares ISA. Choose a platform like InvestEngine to keep your costs low. If you found this guide helpful, please do like and subscribe for any future content. If there's any parts that you're still unsure of, please let me know in the comments and maybe I'll do a part 2 to this video. Thank you for watching and I'll see you in the next one.